A trailing stop order is a modification of a typical stop order that can be set at a defined percentage or dollar amount away from a token's current market price. A trailing stop is designed to protect gains by enabling a trade to remain open and continue to profit as long as the price is moving in a trader's favor. The stop order will be executed if the price changes direction by a specified percentage or dollar amount. Trailing stop only moves in one direction as they are designed to lock in profit or limit losses. The trailing stop will move up once a new peak has been established, and once the trailing stop has moved up, it cannot move back down. The key to mastering this method is to successfully set it at a level that is neither too tight nor too wide. This is definitely difficult as there is never an ideal distance, since the way crypto moves is ever changing. Setting a trailing stop that is too tight might result in a small losing trade. Setting a trailing stop that is too wide will then make the trade insensitive to normal market movements. This means that the trader might be taking unnecessarily large risk. They might be making unnecessarily large losses or giving up more profit than need be. What is then an ideal percentage or amount? Let's take a look at an example. If you bought FOLO at $1,000, by looking at past records of the token, you estimate that the price will often experience pullbacks of 3% to 6% before moving higher again. These past records are important to establish the ideal percentage level or amount to use for a trailing stop. If you choose 1%, 2%, or even 3%, the trailing stop might be too tight, and this will mean that your trade is very likely to be traded by the trailing stop before the price has a chance to move higher. This means that you can be making more profit, but the trailing stop actually prevented you from doing so. On the other hand, if you choose 20%, that will be too wide. This might make you very vulnerable to huge losses. An ideal might be 8% to 10%, where it will give the trade room to move but also allows the trader to exit quickly if the price drops more than 10%. So how does trailing stop work? For example, if a trader is using a 10% trailing stop and buys at $1,000, your broker will execute a stop order if the price drops 10% below your purchase price, which is $900. If the price never moves above $1,000, the trigger price will stay at $900. However, if the price moves up to $1,200, your trigger price will then move up to $1,080. The sell order will be executed if the price drops below $1,080, even if the price falls below $1,002. Your trigger price will then remain at $1,080.